Have you ever wondered why President Trump launched tariffs not just against China, but almost every major U.S. trading partner? Or why bringing manufacturing and investment back to the U.S. became such an urgent national goal? Today's video breaks it all down, through the lens of government debt, global finance, and America's future. If you like real, fact-based explanations, don't forget to subscribe and stay with us. At first glance, America's debt-to-GDP ratio, around 123%, doesn't look catastrophic. Japan's is even higher, and they're still standing. But debt-to-GDP only shows part of the story. Let's define two important terms. GDP is the total value of goods and services produced by the U.S. economy in a year. Revenue is the money the government collects through taxes and fees. Here's the critical difference. Federal government revenue is only about 17% of GDP. If you include state and local taxes, it rises to about 26% of GDP. Either way, the U.S. collects far less revenue compared to many developed countries, meaning it has less margin for error when it comes to managing debt. The real risk isn't just the total debt, it's how much interest the government has to pay every year to keep it alive. Today, over 10% of federal revenue already goes to interest payments, and that number is climbing. After June's massive debt rollover, it could reach 15% or even higher if rates stay elevated. Interest is now one of the fastest growing parts of the federal budget, faster than defense, Medicare, or Social Security. Starting in June 2025, nearly $3 trillion of U.S. debt will mature, mostly short-term Treasury bonds. And when you add refinancing needs and new deficit spending, the Treasury could be rolling over more than $7.6 trillion between June 2025 and June 2026. That's a lot of debt at higher interest rates, and it's a silent pressure that could reshape everything from interest rates to tax policy. There are only three real options: raise more revenue, through taxes, tariffs, or faster growth. Cut government spending, politically difficult and slow. Lower interest rates, but only if inflation allows. Each option carries risks, and none are easy. This pressure helps explain Trump's broader strategy: use tariffs to raise hidden revenue without formally raising taxes. Force companies to bring back factories and jobs. Reduce dependence on fragile overseas supply chains. If government spending is limited, then private investment must drive GDP growth to avoid economic stagnation. The US dollar remains at the center of global finance. Nearly 60% of all global currency reserves are still held in dollars, far ahead of the euro at around 20%, and the Chinese yuan at just 3%. One big reason is the U.S. Treasury market, still the world's deepest, safest, and most liquid bond market. Foreign governments buy treasuries not just to earn a return, but because they anchor their entire financial systems on the safety and liquidity treasuries provide. But why can't other currencies challenge the dollar? The euro lacks a unified fiscal system, political risks make it vulnerable during crises. The Chinese yuan is held back by strict capital controls, investors can't freely move money. The Japanese yen is strong but limited by Japan's smaller economy and persistent deflation. In short, no other country today offers scale, liquidity, and legal protections like the U.S. system does. Some countries are exploring alternatives, like the BRICS coalition, which includes Brazil, Russia, India, China, and South Africa. They've proposed new trade settlement systems to bypass the dollar. President Trump has warned about these efforts, calling them a direct threat to U.S. financial dominance, and signaling that tariffs and other penalties could be used to defend the dollar's role. Still, today, no alternative offers the trust, legal framework, and financial scale needed to replace the dollar system. Behind the scenes, Washington is quietly discussing ways to lock in foreign demand, including the idea of creating special low-interest treasury bonds for sovereign investors. The goal: keep countries tied to the dollar system, even if it means paying slightly less interest to those buyers. Owning U.S. treasuries becomes not just an investment, but the price of participation in the global dollar-based order. If treasuries ever become too volatile or risky, global reserve managers would slowly diversify away. More gold, more non-dollar assets, and more fragmentation of global finance. And it's already starting. After waves of new tariffs, some countries are already shifting small parts of their reserves, seeking more stability outside the U.S. financial system. It's not a collapse, it's a slow loss of trust, playing out over years or decades. And once that trust starts slipping, it's very difficult to rebuild. Today, foreigners quietly help finance America's living standards by buying U.S. debt and keeping borrowing costs low. If that trust fades, the US government would face higher interest costs, and American households could feel it through inflation, slower growth, and falling purchasing power. Global financial dominance doesn't collapse overnight. After World War II, it took decades for the British pound to lose its status, even as the US economy was already rising. Reserve currencies fall slowly, through many small losses of trust. It's not just about tariffs, deficits, or financial headlines. It's about trust, stability, and what kind of future America wants to build. Because in the end, the strongest currency isn't paper, it's confidence. If you found this breakdown helpful, please subscribe. Understanding the real money flows is how smart citizens and investors stay ahead of the curve. And if you want to see how tariffs are already reshaping the global economy, check out our video, Tariff Inflation is Here, and Even the Fed Can't Save Us. It's linked below. Also, if you're curious how companies like Tesla are repositioning for this new world, watch Why Tesla's India Play Could Change Everything, or Go Nowhere. That video is also linked for you. Every move today connects to a much bigger shift tomorrow.